Welcome to this deep dive. We're cracking open a recent weekly market recap you sent our way.
Brilliant.
Mission today. Really pull out the most crucial insights, especially, what the latest data is telling us about the U.S. economy, the financial markets.
And a big piece of that puzzle right now, according to this source, is definitely the labor market.
Exactly. So we're going to zero in on that data from the past week, look at what might be coming next, and, well, try to figure out what it all means for the big picture outlook.
Okay, sounds good.
Okay, so let's unpack this thing. The source kicks off highlighting just how incredibly resilient the labor market has been.
Yeah, it's pretty remarkable, isn't it? Especially with all the policy uncertainty floating around.
Totally. And it points to a few key reasons for this strength,
Yeah.
like companies settling into a bit of a no-hire, no-fire mode.
Mm-hmm. Probably after struggling so much to find workers recently. Makes sense.
Right. Plus, consumer spending as well, it's still holding up. And there's definite strength in specific spots like defense and healthcare.
Yeah, those sectors keep coming up.
And looking at the headlines from last Friday's jobs report, the document confirms another 139,000 jobs added.
Okay.
Unemployment rate steady at 4.2%. And JOLTS openings, the job openings number actually went up to 7,391,000.
Wow, okay. So on the surface, yeah, those numbers definitely paint a picture of, well, ongoing strength.
But
But yeah, what's fascinating here is that while those headline figures look stable, the source digs a bit deeper and identifies some hints of weakness emerging.
okay, like what?
Well, specifically, it points to the non-farm payroll numbers for March and April. They saw significant downward revisions.
Downward revisions, how much?
We're talking a total of 95,000 fewer jobs than they initially reported across just those 2 months.
95,000. Wow.
Yeah. And that kind of revision, it could be a signal. Maybe some softening momentum under the surface.
Right, okay. And here's where it gets really interesting, I thought. The report also highlights continuing jobless claims.
The people getting benefits for more than a week.
Exactly. They've actually reached a recent cycle high, based on their 4-week moving average anyway.
That's a notable data point.
Yeah.
And to add another layer, the source mentions the labor market differential.
Oh, yeah, the survey thing. How easy people think it is to find a job.
That's the one. It's currently sitting at one of its lowest points in the past year.
So what does that suggest?
Well, it suggests that even with a low unemployment rate overall, maybe those who are actually out of work might be facing, real hurdles finding a new position.
Okay.
And if that keeps up, it could potentially nudge the unemployment rate higher in the coming months.
So we've got this, tension right. The headline, job creation looks okay, openings are up.
But past months revised down, claims are rising, and people feel like it's harder to find work.
Yeah. But what about actual layoffs? Are companies shedding workers?
Exactly, and this is where the picture gets, well, more complex. The source notes that while we're seeing these signs of, say, slower hiring and maybe more difficulty finding jobs, JOLTS layoffs, the actual number of people being let go, they remain largely in line with their long-term average.
Huh. So not a wave of firings.
Not really, no.
Okay.
But divergence is interesting. It suggests the market isn't, collapsing, but maybe seeing a slowdown in the pace of hiring and a challenge for the unemployed to actually land those available roles. It's kind of a shift in dynamic.
Okay. So putting this all together, this mix of, lingering strength, but also these emerging cracks, what does the source say this means for the broader economy, for you listening?
Well, the source draws a pretty direct line from the labor market's health to consumer confidence, and crucially to consumer spending.
Makes sense.
The argument seems to be if people can generally hold on to their jobs, even if finding a new one is tougher,
Yeah.
overall confidence might not take a massive hit. And if confidence doesn't tank, spending could potentially stay healthy enough to keep the economy, chugging along, maybe even into 2025.
Right. Jobs mean income means spending. Simple enough. But how do these mixed signals in the job market play into what the Federal Reserve might do? Interest rates.
Ah, yes. The Fed, well, the source notes that long-term yields bond returns initially jumped, up 11 basis points after that May jobs report headline number.
Okay.
And yields have also been pushed higher recently, just generally,
Yeah.
because of worries about inflation, government debt, that sort of thing.
Right. Those background concerns.
Exactly. However, with these emerging signs of weakness we just talked about in the labor data, the revisions, the claims, the differential, the source indicates the Fed is now seen as, well, more likely to consider cutting rates if those conditions genuinely deteriorate further. The softening data gives them potential cover, if you will.
Okay, so the weaker data could actually pave the way for cuts, potentially.
Potentially, yes.
Yeah.
And that possibility has direct implications for investing, especially in fixed income like bonds. The report suggests this allows investors to look at fixed income, not just for price gains, but specifically for the income it generates.
Right, the coupon payments.
Exactly. Without quite as much fear that rising rates are going to immediately hammer the value of their bonds.
But what's the actual advice here?
Well, the advice in this document right now is to maintain a neutral duration stance.
Neutral duration, meaning don't bet too heavily one way or the other on rates?
Pretty much, yeah. They're advising investors not to make a big call on whether interest rates are going to dramatically rise or fall from here. It just reflects that murky outlook. Strength here, weakness there, uncertainty about the Fed.
So play it safe on duration for now.
That seems to be the takeaway.
Yeah.
Taking a neutral stance is sort of a way to navigate that uncertainty.
You got it. And the source, it doesn't just stop there, right? It includes a ton of other market data.
Oh, yeah, definitely. It shows how everything reacted. We also see the source highlight how equities responded to this whole economic backdrop.
Like sector performance.
Yeah, showing shifts in sector and investment style performance, for instance. Certain areas might be showing resilience while others lag. It reflects the market kind of digesting these conflicting signals, trying to figure out winners and losers.
And it covers currencies, commodities, too.
Yep, all part of that broader market picture, responding to the economic story we've been unpacking.
Okay, so we've really dug into this weekly market recap you provided. We pulled out that core tension the source presents, that headline strength in the labor market, kind of bumping up against those specific, maybe subtle signs of potential weakness underneath.
Exactly. And we've talked about how that delicate balance influences the potential path for the economy, how it impacts consumers, spending.
Shapes expectations for the Fed and interest rates, and how it's all reflected across different markets, bonds, stocks, everything.
And understanding these nuances, these details for the sources you bring us, it's really key, isn't it, to cut through the daily noise and see the bigger picture.
Yeah.
It helps you recognize that economic data isn't always just one simple story. Often, like here, it presents these conflicting signals that, well, they require some careful thought to really grasp the full landscape.
Absolutely. So, as you think about all this, here's something maybe to consider. Given that the source highlighted this increasing difficulty for unemployed folks to find jobs, but at the same time, overall layoffs haven't really spiked. What does that specific divergence hiring slowing down but firing staying stable, what does that tell you about the underlying health, the future path of the labor market? Maybe something beyond just the headline numbers we hear about every day.